This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collecting trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. Today's episode dives into one of the most topical trends in the evolution of wealth management platforms and their adoption of private markets. We are joined by Tom Cohn and Amita Schultes of Cerity Partners, where they discuss the recent combination of their two respective businesses, Cerity Partners, the $80 billion plus and growing national wealth management firm, and Agility, a leading OCIO business. Tom and Amita discussed their merger, why there was a need to create customization for wealth investors in private markets, and how bringing on a leading OCIO business takes Cerity Partners' capabilities to a new level as a solution provider in private markets. Tom is the Chief Client Solutions Officer and a partner in Cerity Partners New York office. He is a member of the firm's leadership team. He has over 10 years' experience in various investment management roles, previously serving as an investment analyst at Spero-Smith Investment Advisors, where he is responsible for due diligence and analysis of third-party managers and assisted in global market and asset allocation research. Amita is a partner in Cerity Partners New York office, managing Cerity Partners OCIO client portfolios. She's a member of the OCIO Investment Committee. Amita brings over 20 years of experience as an investment consultant to bear for the firm. Before joining Cerity Partners, Amita was a partner and client portfolio manager at Agility, where she served as a voting member of Agility's investment committee. Prior to Agility, she was a partner, managing director, and senior consultant at Colonial Consulting, serving as an investment consultant for endowments, foundations, and pension plans. She also served as a senior consultant at Ibbotson Associates. Tom, Amita, and I had a fascinating discussion about the why and the how behind Cerity Partners' merger with Agility, how wealth management platforms can balance customization and scalability, why scale matters in wealth management, and how alternative asset managers can differentiate when it comes to engaging with the wealth channel. Thanks, Tom and Amita, for coming on the show to share your views and wisdom on wealth management and private markets.
We're going mainstream.
Amita, Tom, welcome to the Altco's Mainstream podcast.
Thank you. It's great to be here.
Yeah, great to be here.
Pleasure to have you. I think we have a really interesting conversation on tap because we have the merger of two firms here, Agility Partners merging with Cerity Partners. We have institutional investment and allocation experience. We have massive wealth platform. I think you called it Super RIA. So I think there's a lot of really interesting things to talk about the why, the how you've all worked together, your backgrounds. I'd love to start there just because I think that will explain so much of your perspective on things. So Tom, given that Cerity has been around for a while, I'd love to start with your background and then go to you, Amita.
It's a pleasure to be here. I fell completely backwards actually into this industry. So I went to grad school with all the intention of going into asset management. I like to joke, I didn't know the difference between an IRA or an RIA when I started. And almost by accident, I ended up at a wealth management firm in Cleveland, Ohio, of all places. And it turned out to be kind of the best career decision of my life. That firm ultimately ended up merging into what was then Cerity Partners. So I've been lucky enough to be here for 8.5 years at Cerity Partners. I started on the investment side, really helped build out our investment office, supporting our advisors and clients on all things asset allocation, manager research, private markets. And now I'm lucky enough to oversee not only our investment platform, but a number of the other central solutions or services that we provide to clients.
That's a great transition to Amita. You use the word manager research. That's something you've done for pretty much your entire career. So we'd love to hear your background and expertise there.
Like Tom, I started at a different place. I wasn't expecting to end up in the asset management space. I'm the daughter of immigrants, and there were two things that you could do. You could become a doctor, you could become a lawyer. And so I was pre-med in undergrad, but had a really strong interest in economics, and so majored in economics. And as I was graduating, met someone that worked at Smith Barney in Chicago in their consulting group, and they were looking for someone on the manager research side. I convinced my father to let me take that job, which I think was one of the best things that could have happened, because that's when I started my career doing manager research. And this was in the mid-90s. I spent a number of years there and then moved on to Ibbotson Associates in Chicago, where I had an opportunity to work in their consulting and research group, where we designed asset allocation programs for broker-dealers and insurance companies, where we were building all of the model portfolios inside annuity vehicles and sometimes inside wealth platforms. I then moved to New York, where I became an investment consultant with Colonial Consulting at the time, a non-discretionary consulting firm, started working with endowments and foundations. And for me, that's when things like really clicked. I absolutely love working with nonprofit organizations, did that for 16 years before transitioning to Agility and doing the same type of work, but on a discretionary basis, continuing to work with endowments and foundations and other large institutions. So it's been a really long career of building multi-asset class portfolios for institutions and doing manager research. And I absolutely love every single day.
Well, you have had to diagnose portfolios and prescribe investment solutions. So maybe not quite a doctor, but close enough in this world. So that's a great background in terms of setting the stage for the conversation of the merger between two firms, right? I think there's a lot of really complementary pieces of what you're doing. And I think what Cerity and Agility have done to come together is really emblematic of some key trends in private markets. Cerity Partners already had a fantastic business and investment process working with private markets in particular for quite some time, but adding an institutional investment consultant, I think, is a really interesting theme and trend. So would love for you to just unpack why you all decided to partner together.
It's a really good question. And I think there are a lot of powerful benefits and synergies to an OCIO business and a wealth management business. So maybe start from the top. We service three types of clients: individuals and their families, and we provide comprehensive wealth management that includes investment management, which a lot of times will come with private markets exposure, financial planning, estate planning, insurance planning, and tax preparation and planning are usually the key components that we're delivering to an individual or a family office. We service corporations, both in terms of providing those same wealth management services to executives, and as well as being a consultant to corporations on their 401k or retirement plans, and now have capabilities to provide corporate venture capital, actually building customized portfolios of venture capital companies for corporations that have a strategic value. And then the third segment is endowments and foundations. And as you can imagine, when you work with hundreds or even thousands of individuals, a lot of them serve on boards. They know either an endowment or foundation. And so as we thought about that capability and building that out, OCIO is a natural complement. A lot of the things that Amita and the partners on the OCIO practice do are very similar to what we're doing for a family or an individual. right? We're setting an investment policy. We're understanding the goals of an organization or family. And then we're building customized portfolios that can deliver the returns at the right risk for either an individual or a endowment. So I think it's a natural complement to what we're doing. There are some differences, which I'm sure we'll discuss, of how you build a portfolio or how you may think about the constraints or the needs of a foundation versus an individual. But I think that the kind of base level of needing to provide really expert investment advice, being able to do in-depth manager research, both on the public markets, now increasingly on the private markets, is very similar. And to be successful in either OCIO or wealth management, you need to do that at a high level.
So I want to pull on that thread a little bit more before going to you, Amita, and hearing your perspective from the agility side of why it made sense to partner with Cerity Partners. Tom, why did you decide to look outside of the firm rather than build yourself? And also, why now?
It's a really great question. So one, I think for us, Cerity Partners is a partnership. That's an important part of our DNA. And I think what's made us successful is that we have a partnership mentality. We're owners in the business. We're entrepreneurial. We're constantly thinking about how do we get better? How can we better service our clients? How can we service more clients in the same way? And so what was critical was that we found the right partner or the right group of partners to be able to enhance what we do to provide OCIO services. And Amita and the other 5 partners of our OCIO practice really embodied that. They had the same mentality. There was cultural alignment in terms of the approach to thinking like a partner, to thinking like a business owner. So that was one. I think the second piece was, there was deep expertise in actually managing institutional portfolios, having a solid track record, and also the ability to service really complicated and sizable institutions. And so those two things together were something that we found really attractive, right? That you have the right people that share the right cultural DNA and have a track record in a business of being able to do that in a repeatable way.
And Amita, from your perspective, you built fantastic business at Agility. What made you decide to say, as a partnership at Agility, okay, it makes sense to partner with a wealth platform? Obviously, I would already work with endowments, foundations, so there's probably a natural fit there. But that's maybe a departure from what firms might have thought about in the past of, hey, an OCIO business becoming part of a wealth management business.
To us, we really saw a vision of a potential for a symbiotic relationship that could exist if done well, where we could have sharing of some really critical infrastructure and resources, whether it be on the human capital side or the legal compliance side, broader finance function, and allowed for an expansion of a research effort that we had built over many, many years by supplementing with economics research, market research, additional manager research. Finding the right firm, though, was very important, and it was a very long process, but I do feel like we've landed in the right place.
How much of this partnership is also a signal that the wealth management channel is really almost an institutional LP in the private markets world? Was that part of the decision to say, hey, you know what, let's partner and work with a wealth management platform, because the wealth management channel is increasingly becoming a more important LP in the eyes of alternative asset managers?
For us, it was more that we felt that we had some expertise that we could share with other end users, so to speak. We'd always been doing it for endowments and foundations and large institutions, but as we're sitting around at those board meeting tables and investment committee meeting tables, there were individuals around those tables. And over the course of time, we had been approached by some of them to see if we could do, what we were doing for those institutions for them individually. And we did not have the wherewithal at the time to do that, because we, spent so much of our time focused on non-taxable nonprofits. And I think the marrying with Cerity Partners allows us to have that depth of expertise through our colleagues and partners.
It's a great transition, because I know, Tom, we've talked about this where Cerity Partners really looks like an institutional investor to the alternative asset managers in terms of the size and scale at which you're allocating to certain firms, the way you're partnering with them. That looks very institutional. Obviously, the end investor might be smaller individual investment sizes, or structurally you have to do things differently. But how has the business of Cerity Partners evolved when it comes to working with private markets firms?
Well, private markets have just become that much more important. So when I started my career in wealth management a little over a decade ago, private markets was an important part of what we were trying to bring to particularly our ultra high net worth clients. But I think, particularly after the global financial crisis, where the regulatory regime moved a lot of businesses, even up until today, outside of banks and into what I would call the asset management community. We've seen just companies, for a variety of reasons that we could get into, stay private longer, which means you need more capital in the private markets. You need different types of solutions in the private markets. That's increased, I think, the overall need in a client portfolio, whether it be an institutional client or a wealth client, to have more exposure to private markets. And so we see that trend continuing. And we've made a dedicated effort and focus on building out the infrastructure to be able to deliver private markets to, all our clients where appropriate. So what that means is, one, we need to build out a deep level of expertise on the investment side. So you asked the question of why now for coming together with an OCIO business. Part of that was just enhancing what we already do in terms of our research team. So we wanted to expand that. And it's natural that an OCIO business with the focus on private markets is going to help us enhance that. The second piece is the operational component. So to be treated like an institutional investor by general partners, not only do you have to have great investment expertise to go out and source, diligence, ask really good questions, but you have to act like an institution in terms of working with them on an operational standpoint. And I think in the wealth management side, where you have more clients that are going to allocate than a institutional LP, we spend a lot of time thinking about how do we, one, make it easy for our clients to invest in the private markets? And almost as importantly, how do we make it easy on our GPs, where we have really strong partnerships, that we're not creating a burden on them with hundreds, it could even be thousands of investors going into a fund. And so we spent a lot of time thinking about that. In the OCIO business, because they're doing that for tens of clients, they have a deep track record in that, there's a lot of knowledge of building those portfolios that we can transfer and use to think about how do we deliver the similar portfolios, not always going to be the same, to private wealth clients.
I think you said something in there that was really important and interesting, which is making sure you have the research team built out and the coverage. So the wealth channel, the benefit of being independent is you're a fiduciary. So you can be open architecture. I think the blessing of that is you can do whatever you'd like and find the right manager for the right client. The challenge is coverage. So I think that brings this to you, Amita. I think from a OCIO perspective, you obviously have years of working with managers. You have the ability to probably cover so many different managers' strategies in a way that many on the wealth management side may not have because of just the time spent in private markets, et cetera. So how do you think about the process through which you do manager research, continually scan the market, see who's going to be in the forward calendar of who's coming to raise, how to think about all of that when it comes to marrying that with the wealth management side and integrating that into the research process as a fiduciary?
I would say that our philosophical investment approach stays very much the same. We still have to do an exceptional amount of due diligence on both the investment diligence side and also the operational due diligence side. So that doesn't change. What does change is the ultimate manager selection and whether those certain managers, strategies, funds are appropriate for institutions versus a wealth management client. And those decisions hinge on a number of key factors. It might hinge on something like taxes. I mean, on the institutional side, we've always been net investors, meaning, we're looking at the bottom line returns. Taxes come into play as it relates to UBTI, and we consider that as sort of an additional expense or cost of making the investment. But clearly on the wealth management side, taxes come in to play in a different way. So we've got to be cognizant of that tax implication. It also comes into play, as you might imagine, on the institutional side. Our clients are perpetual in nature. They don't die at all. And so that gives us a lot more flexibility in terms of not just the length of the investment that we can make and the commitment, but whether we need capital to come back in the form of distributable yield, for example. On the wealth management side, that whole element is slightly different, whether it be just the time horizon of a person's lifespan or liquidity needs on an ongoing basis. Things like risk tolerance and preferences come into play quite a bit as well on the institutional side. Because of the perpetual nature of the institutions, we have, frankly, the luxury of time. We don't have to be so concerned necessarily with a lot of volatility, tracking error, downside deviation. That's not to say that all organizations are the same, but painting with a very broad brushstroke, that tends to be the case. Where on the wealth management side, that element might be somewhat different.
How much does the working with either side, the institutional side or the wealth side, that you mentioned some of the differences, but how much does it actually complement each other? And are there things that you can take from working with an institutional investor that you can then bring and apply to the wealth channel, or vice versa?
I think the element of focusing first and foremost on investment objective is the same for both channels. We really need to think about what's the long-term goal of this organization, or in the case of the wealth channel, of this individual or this family, and how can we help build a portfolio to help them meet that objective while still taking into account their tolerance for risk, their appetite for volatility, their ability to withstand tracking error, their ability to not have liquidity coming out of the portfolio at various points in time. All of that is the same for both practices, and we may make different decisions on the OCIO practice than we do on the wealth management practice, simply because everything we're doing is so bespoke and customized and tailored to the end client. But the philosophy and approach is the same across both.
And Tom, do wealth clients look at the now institutional side of the business you have and say, oh, wow, this is really different and unique. I now have access to different set of tools and capabilities than I might have otherwise?
Absolutely. One of the things why we came together and why I think the combination of our two businesses is so powerful is we're a partnership. And so there's not independent groups in here. We are all stakeholders in the same business. We're all committed to servicing all of our clients, whether they're a corporate client, an individual client, or an endowment or foundation. And so one of the things that, as we came together, was really critical for the OCIO group and the wealth management team is that we have a common research platform. So as Amita described, there may be specific investments that are more appropriate for a specific client, no differently than we deal with today on the wealth channel. A larger client may have a higher aptitude to take illiquidity risk than a smaller client. Or a larger client may not have the background within private markets and therefore may have a lower allocation of private markets. That's something we deal with every day, and our advisors are well equipped to assess the risk tolerance and needs of our clients. But what we wanted to do was make sure that the research platform was consistent. So the way that we approach operational due diligence, the way that we assess a manager, whether it's a venture capital manager or a private credit manager, is exactly the same. And so I think that is a really critical component when we look at Cerity Partners and our approach, is that underlying discipline around the manager search process, the due diligence process, is going to be consistent. There are going to be differences between a OCIO portfolio and a wealth management portfolio. And I think we're increasingly seeing, this gets back to the question around why now, where we see large family offices, we see larger high net worth clients that want a more OCIO approach. And I think, increasingly we want to be able to deliver that solution, which is really critical. And now we have the capability and the track record to be able to deliver that.
I think that's a really interesting thread to pull on, because if you think about the arc of private markets and investors allocating to private markets, historically it was mostly institutions, large family offices, obviously, but those firms looked more like institutions. Institutional investors have had a certain type of access that the wealth channel has not until recently been afforded. Does the ability to have both the institutional relationships and work with managers from an institutional allocator perspective, has that opened up different doors or provided different types of access or different types of manager relationships than it has been in the past for the wealth channel, or vice versa too? The fact that you have a very large wealth business, has that brought institutions into certain things or new products? I mean, the evergreen question is an interesting one, where really built more for the wealth channel, but some institutions may want to use evergreen products for certain reasons. So how has that interplay manifested itself in the time that you've worked together, and how do you see that unfolding? Tom, we'll start with you, and then Amita will go to you.
Yeah, I think there's two dimensions to it. So the great thing about the expansion of the private markets is there's more solutions out there to meet the needs of a variety of different clients. The challenge with that is you have tens of thousands of funds out there in private credit, private equity, venture capital. You have co-investment opportunities that can be really interesting and attractive. And you have to ask yourself, well, how do I go out and actually vet thousands of opportunities in any given year? And so you have to build out a really strong and deep research team. And so I think that the complement of the OCIO business is we're able to take a really great research team that we had already built out at Cerity Partners and add to that. We have 35 colleagues in our investment office, and the vast majority of their job is dedicated to going out and selecting new managers, vetting new opportunities, and then doing the ongoing due diligence for our client portfolios. And so one, I think, is you have to have a really strong and deep team that mirrors like what you see on the asset management side. The second piece of that is, you have to have experience with relationships with GPs, longstanding relationships, to get access. And so those relationships are really critical. And I think by building out a 35-person research team, we have access to that. The second component is, I think size can be of benefit. You can be treated like an institutional investor. We mean by a large endowment or a large sovereign wealth fund or pension fund, now where we can commit hundreds of millions of dollars of capital into a particular investment if we come together. And so I think that marrying of the size to be treated like an institutional LP and the deep expertise on the research side to go and vet and search and stay in contact with GPs is the powerful combination of our organization now.
Are you finding that you're doing investments where institutions will allocate to the same investment that the wealth investors will?
Yeah, increasingly those relationships are really beneficial, where we can think through how do we come together as an organization. So the research team is doing all the vetting, making the decision, and then we obviously have approval process for thinking about the appropriateness of an investment into certain client portfolios. But the power of having that capital across institutional and individual portfolios is really powerful. And we're at our best when we're working together. I think that's the benefit of the partnership model. It's the benefit for clients, that it's the thinking of every colleague across the firm is, how do we service every client? And how do we bring the best of what we have to every client where appropriate?
The one thing I would add, you mentioned access. Access is one of those things. Either you have it or you don't. We've been fortunate to have it, I think, because we've been in business for a very long time. We have a 20-year track record. Over that course of that 20-year period, we have been investing in private markets every single year. And so it's the longevity of the relationships, the stability of our team that allows us to have those really long relationships and have access.
I think that's a really important point. It ties really well with what Tom ended with, which is how do you create the right solutions for each client? You've spent tons of time figuring out the right customization for each client. So how do you think about marrying both access with customization when it comes to working with clients in that regard?
I think it's a natural fit because not one solution fits every single client. That's always been the case, whether it be on the OCIO practice or in the wealth management practice. Finding the right solution is key. Having more colleagues in the mix to think about where the customization could come into play is quite helpful. It's hard to paint with a really broad brushstroke, however, because we see it in the institutional side where there might be a very financially robust institution with a really strong balance sheet, a lot of fundraising and cash flows coming in every year, and they can withstand a lot of illiquidity in their portfolio. So even as we're digging below just having a private markets allocation, as we're thinking about what types of private strategies are appropriate for them, we can do things that are a little bit earlier stage that might not throw capital back or have exits in a near-term time period. And there are some institutions that don't, frankly, have that same financial wherewithal, that we have to be a little bit more mindful of when exits are going to be coming. And so we might shift a little bit more later stage for that reason. And the same type of thing applies for the wealth management channel.
I think that brings up a really interesting point because it feels like the wealth channel's adoption of private markets is in the phase where customization matters, and that's a differentiating factor. But at the same time, you have to think about scalability. How do you apply that from the OCIO perspective? And then, Tom, I'll get to your perspective from the Cerity Partners platform side. But how do you think about the marrying of this customization with the ability to make that scalable, make it worth your time, spending time on a manager, allocating to them because you now have, you've had and continue to have an even larger pool of capital. So you have to balance those things. So how do you deal with that?
I think we have to make room for both, and we will make room for both because it's important to have both options for client portfolios. It's important to have those niche sector-focused funds, for example, for clients that already have robust private markets portfolios where we have a really good grounding and a base, a lot of diversification, and we're layering in very specific focus strategies to create some more opportunistic investments in their investment program. We're going to have clients who are starting from a very low base in terms of private markets allocation or no private market allocations to speak of. And so there we'll want to start with a more broadly diversified approach, a broader range of strategies. And so we'll have to make space for those as well. But that's always been the case. We've always had to have those types of strategies in place. And being able to come to the table knowing that we have a bigger capital base that we're trying to allocate from is frankly helpful. It allows us in getting seats at the table, having more conversations. It helps us in negotiating fees, for example, with managers as well. So it seems to me to be a win-win on both sides.
You bring up a bunch of points that I think you've had to think deeply about from the structuring perspective. You talked about the operational challenges of this. How do you think about marrying those two aspects of customization with scalability?
I think it's knowing where to customize. When you have thousands of clients, you have thousands of different financial plans and needs in terms of the ability to take illiquidity risk, comfort level with private markets. There's a huge educational component with an individual. We want to make sure that every client understands their investments. And so we spend a lot of time educating our clients, educating our colleagues around what we're doing, why we're doing it. And so I think you need to think about a framework, one, and that framework that we think about is very consistent in the OCIO side and the wealth management side. And once you have that framework in place about how you think about or categorize the private markets, the specific characteristics of why a credit fund would be appropriate or what that's replacing from the public markets when we make an allocation decision, I think that allows you then to customize the portfolios specific to the client. I think the second component that just goes back to resources. If you want to create custom portfolios, it means you need more resources to go out and vet more opportunities. So Amita touched on, we're going to have niche opportunities that are going to be appropriate for a subset of clients or maybe a smaller portion of the portfolio. Well, to do that, you need a large team that can really span the universe of private credit funds or niche lending strategies or particular segments of the venture capital market. And I think that comes back to the importance of why we wanted to add an OCIO business is it enhances every client relationship by having the depth of that research team.
So then for both of you, you mentioned some really interesting and important themes, negotiating fees, that net of return, net of fees is what matters for investors, right? So that can be really important. You talk about different ways in which you can structure certain solutions, different categories or asset classes, and how you approach that. What do you both think is the next innovation in terms of investment solutions when it comes to productization of, is it evergreens? Is it model portfolios? Is it something else that you see as the next frontier of innovation when it comes to building the right types of solutions for private markets for clients?
I think having a turnkey solution that fixes a lot of the operational complexities of investing in private markets is where we need to get to on the wealth management side of things, and also on the institutional side of things. So I think on the institutional side, there have been some solutions for a bit of time now. And what I'm referring to, of course, is every time you make a commitment to a manager, there's a whole set of documentation that needs to be filled out. There's a lot of capital calls, distribution notices, et cetera, and that just creates a lot of operational complexity for individuals and for institutions, frankly. Having a turnkey solution that allows them to make a single commitment, gets them exposure to a wide range of strategies that is, if they're starting from a low base, likely appropriate for them, where we can potentially layer in some more unique and interesting strategies, would be a great next step for investors.
That was where I was going to go next. Was it feels like that's starting to happen. Either platforms or larger firms are creating their own model solutions, either on their own, in partnership. BlackRock Partners Group is one example. iCapital has model portfolios. There was the recent partnership with InvestCloud for the PMA, right, as part of the SMA and the UMA. So there's all this stuff that's happening. But then I guess the next question becomes, so how do you then add in some of these more unique or bespoke strategies into something? Because on one hand, I don't disagree by any means that the model portfolio innovation is critical for the wealth channel, particularly for those who don't have access and they just need turnkey exposure. But then how do you find the right managers for each strategy and solution rather than maybe just work with one manager across the board? Because certain firms are, as you know from doing this for quite some time, for both of you, like certain firms are better at certain things. So how do you think about that aspect of this evolution in the model space?
It's here, I think it's combining what we've been doing in the OCIO practice with what potentially could be done on the wealth management practice, which is building commingled structures where you get exposure to a number of managers underneath a number of different strategies. We can be very active in making those selections. In the case of public markets, very active in doing rebalancing within those commingled fund structures. And if there are unique situations for individual clients, whether it be on the institutional side or the wealth management side, we can then layer on top individual managers and strategies to help better customize for that specific situations. And you can do the same thing on the private market side as well, where you're getting exposure to a broad range of managers and strategies, and then layer on specific niche opportunities as you may see fit.
Tom, how do you think about this space evolving in terms of next innovation around structuring of solutions?
It's a combination of things. So I think there's a lot of great partnership between LPs and GPs in terms of innovating structures that make it easier to access private markets for a larger amount of clients, to make it easier to invest, certainly reduce the burden from the tax side by reducing the number of K1s. I think there's also a component where we've spent a lot of time thinking through what I'll call the workflows of private markets. So you start with a subdoc, and you have to think about filling out all this information, and that information from one GP to the next may look very different, but the core of that information is substantially similar. Then you move to actually having to fund that investment, capital call management process, which can be onerous at times. When you build a private market portfolio of 10, 20 names, now you have 10 or 20 capital calls that you have to fund. And then finally, the reporting and actually managing distributions. So if you think through that life cycle, I think there's great technology emerging at every point. I think the key for any any firm, whether your OCIO business or wealth business, is how do you integrate that into the total client experience? And that's not something necessarily that technology can fully solve. You have to build a really good layer of experts on the operational side, so on the client onboarding side. And so we spent a lot of time, and I think this gets back to, the OCIO business had deep expertise, not only in the investment side and the client portfolio management side, but on the internal accounting team and client onboarding team. And so taking those workflows and integrating that into the process, I think has been a key component for the proverbial easy button when it comes to private market investing. And then I think, as you said, the other side to that is more unique and interesting structures that just are easier to use for advisors and clients.
I think that's a really interesting point in terms of thinking about where this space goes. I also want to go back to something that you both referenced in some of the things you said, but you mentioned in the context of liquidity, the context of thinking about defining different strategies. We were talking about this before too, the concept of words mattering. When you think about private markets, when we think about words matter, what do you mean by that? And how do you think about that in terms of defining what private markets are? Maybe I'll start with you.
For us, private markets encapsulate a really wide range of strategies. And I would put them into two broad buckets: private capital and private real assets. So in the private capital side, we would put things like growth equity, venture capital, credit-oriented strategies, perhaps some distressed and opportunistic strategies. Buyouts certainly would fall in there. On the private real asset side, we would put things like real estate, infrastructure, sustainable investments, traditional energy, agriculture. The commonality between all of those things is there's a commitment and there's a lockup. Where the definition gets messy is you start to see some of this on the hedge fund side as well, right? Where you have traditional hedge fund managers investing in some private strategies. So the definitions aren't hard and fast, but that's how we would typically characterize private market.
Where do you feel like there needs to be a development in the understanding of definitions around certain aspects of private markets, whether it's just private markets in general, whether it's specific strategies, whether it's words and concepts like liquidity?
Yeah, it's hugely important as we're working with clients and investors in relaying what those definitions are and what the expectations are for the various sub-strategies. And that's the real reason the definitions are important, is so that people get a sense as to, this is the investment I'm making, this is what I should expect, whether it be from a return angle, volatility angle, liquidity angle. It's that relaying of information that's so important. And the expectations will vary and should vary based on where we're investing in that broad private markets landscape, but being able to relay that and communicate that. And it also being very clear on what the role and goal is of each of these investments in the broader portfolio, because even within that private markets umbrella, growth equity and buyout will have a very different role and goal than something like infrastructure and ag, for example.
Yep. And risk profile.
Yes.
Right. How do you think about the concept of words mattering, Tom?
When I started my career, we would use alternatives, and that was the broad-based catch-all for what the time was a lot of hedge fund exposure, some private equity, some commodity exposure, and we've increasingly bifurcated. So when we talk about private markets, it's exactly as Amita said. We think about assets or strategies that are, majority of their operation is truly private capital, right? There's a lockup component. It's not traded on an exchange. And when we think about, hedge funds or marketable alternatives, these are generally strategies, and they can move across maybe private and public markets, but they're strategies in themselves. And so for our colleagues and our clients, we take a lot of time to distinguish between the broad-based term of alternatives and really talk about private markets. And then I think a component of why we like private markets is just a massive expansion going on within the private markets on the private credit side, on the private equity side. And it really comes back to why we find those asset classes attractive, why we find the managers who are playing those spaces really attractive, and then increasingly why we think some unique solutions are attractive. So we talk about kind of a general thesis, which is private markets should continue to expand. There's going to be additional appetite, I think, and interest from the wealth channel. Well, that means strategies like GP stakes or GP secondaries are probably going to continue to expand. You're going to need additional liquidity options in the private markets, no differently than the public markets have evolved and developed over time. We're seeing that in the private markets. That gets back, though, to being able to explain that strategy to a client about why we like private markets and what the components of private markets are.
One other aspect of words mattering and definitions, I think probably influences how you think about private markets, but is also specific to Cerity Partners as a firm. We were talking about that earlier as well, and you educated me on this, that you don't call things acquisitions, you call them mergers and partnerships. Unpack the concept of words mattering in the halls of Cerity Partners.
Partnership is a critical component. I think it is what has made us really successful. And so every time we welcome a new colleague, we think about, does this person fit into the partnership? Is this someone I want to work with for the next 20 to 30 years? Because that's what partnership is. We're trying to create an enduring partnership that lasts over 100 years. So we need to really think about the next advisor that we bring in the door. Is this someone that believes in the partnership model? And secondly, like, that person has to come in and really believe in that. So words really matter. We really take the partnership concept seriously. And in everything we do, I think we're really intentional. So you mentioned the word merger. It's a merger because we're partners. Amita and I are partners together. So there is no acquisition. We're coming together to combine businesses, to combine our clients, to think about how do we deliver the best service, the best experience to our clients. And I believe that you can only do that through a partnership. So that's a merger of ideas, that's a merger of people, that's a merger of best practices. You know, that's truly a merger. That isn't an acquisition of assets or people. That is merging and coming together.
Amita, how did you think about that when deciding to partner from the agility perspective?
What struck us almost immediately when we met our current colleagues at Cerity Partners was that we had very much a common mission with them. We perhaps weren't as intentional with our language, but we could hear in what was important to them commonality with what was important to us. And that was to have a positive impact on the financial well-being of our clients, of our colleagues, and our communities. And that permeates what we do every single day, whether it be on the OCIO practice or whether it be on the wealth management practice. And so that's something I think that has made the merger and the coming together very successful, is that common mission.
There's one other thing that's really interesting about this whole conversation, which is the managers that you partner with. It's a partnership. It's a general partner and a limited partner. You happen to be the limited partner. So I want to take that question and transpose it into the context of, you both have evaluated managers. What are the things that you look for from an interpersonal and cultural perspective that make you feel like it makes sense to partner with these managers?
This is such a great question because over the years we have found that investment manager diligence is much more art than it is science, frankly. I mean, we will certainly look at investment track records and analyze performance and think about that, but it's really important to us to know who we are partnering with, which is the right term to use. And to do that, we have to spend a lot of time with managers outside of the office, frankly. So we'll do things, for example, like taking managers out to dinner because we want to see how much they drink. We want to see how they treat the waiter, how much they're tipping the valet. All of those little bits of information that we can get about them give us a little bit more insight into who they are as a person and who what their firm is about. And we do meet managers, of course, in their offices and have more traditional investment diligence meetings where we're thinking about, are these people investors or are they asset gatherers? Do they have a sense as to how much AUM they can manage in their strategy? Effectively, we're thinking about how much experience do they have managing this specific strategy, not saying that we won't invest in first-time funds or first-time managers, because we absolutely will, but we like to see that they have that experience with that particular strategy somewhere else before having it be a part of what we're offering to clients. We like to see a lot of alignment of interest. We want managers who eat their own cooking. We do that. On the OCIO practice, we like to see managers that have a lot of conviction in their approach, in their ideas. I mean, the markets are cyclical, of course, and investment styles and strategies go out of favor from time to time, and we need to have confidence that the manager themselves has the confidence to stick through their style and strategy throughout a lot of different market cycles. And we want to pay reasonable fees. We spoke already about fee negotiation, and I know that reasonable and fees can feel like an oxymoron sometimes in the asset management industry, but we want managers who are willing to charge our clients reasonable fees.
Financial services can be summed up in probably one word: trust. Our clients entrust us with their capital, with their hard-earned wealth, and we take that responsibility incredibly seriously. Right? We build trust with our clients in everything we do. And I think it works the same way with general partners. We're taking our clients' capital and we're deploying it into opportunities that we think are attractive. But we're trusting those general partners to manage that capital correctly. And I think beyond that, we're trusting them to make the right decisions. So, something you never think about when you allocate to a private equity manager is there's a mistake on a subdoc. That the trust document is filled out incorrectly. And let's say that the general partner makes that mistake. How are they going to treat our clients? How are they going to interact with our team, with our colleagues? Are they going to own up to it? Are they going to get back to us in a reasonable amount of time to fix that mistake? Because that has serious implications with the trust of our clients if we don't get that right. And those are the things that are really hard, when you just think about it from a pure investment perspective. Is this person going to deliver a really high MOIC or IRR? But they're really critical when you partner with somebody over decades, which is really what you're doing on the private capital side. And so we take that trust seriously. We want to create a partnership. We want a GP to walk away and say, I had a really positive experience working with Cerity Partners. They're experts. They ask really tough questions. They hold us accountable, but they're good partners and they're reasonable and they're fair. And we would expect the same out of any general partner relationship. We truly want to be partners over time.
I think that's hitting on such an important aspect, which is, you both said this, but it's all the little things that add up to making an investment decision. I think that also goes into the quote unquote edge that a manager has to some extent. But I'd love for you both, because you've both evaluated so many different managers, so many different strategies over the years. How do you discern what a manager's edge is?
It's a really good question. I think there are kind of two ways to think about it. I think one, we spent a lot of time as a research group and investment committee thinking about structural edges. So in a particular market, is there a benefit to being the largest player in that market? It could mean that you're going to see the most amount of deal flow. You'll have the most power over pricing. And I think there are particular markets within private markets where there's increasing benefit to scale, right, to having a larger team. I think you could see that in the private credit, where you're essentially replicating a bank-like structure. There's benefits to seeing every deal in the market, being able to negotiate, having a lot of connectivity into the sponsor community, having a workout team to deal through difficult situations when there may be a default. There are other parts of the private capital ecosystem where there's decreasing benefits to scale, and you want to be more nimble, and there's a limited amount of capital that you could put in. So I think one is, I like to say, understanding the game you're playing. What are going to be the characteristics of a manager that are going to lead to kind of winning that game? And so we try to think about that from a high level or more macro level. And then I think it gets into exactly what Amita talked about. There are certain characteristics that we look for, and it's more art than science. There's not a checklist that you can just go through and we could give to, someone 1 or 2 years out of college and say, hey, you just follow this recipe and you'll be able to successfully pick, the best managers in the world. You really have to dig into what I would call these different areas. And those areas are, hey, what's your background? What's your track record? How motivated are you? How persistent are you in terms of getting deals done or negotiating? How are you going to treat our colleagues? How are you going to treat the underlying investors? Like, is there a degree of trust? Are you a quality person? all those things we would look for in any public market investment or private market investment.
How do you train your gut to become as algorithmic as possible? Sure, there will always be the art rather than science, but how do you create that methodology to discern what the edge is?
It's kind of how we train our colleagues, right? Trial and error, unfortunately, is the way to do it. And the trial and error doesn't necessarily mean it's a live investment, live portfolio. We're not doing trial and error on our clients' capital, for example, but it's thinking about who do you like as a manager, perhaps not having any capital go into that manager or strategy, and then watching and see what happens over time, not just on the investment side, but also on the organizational side, because I do think that operational due diligence is an often overlooked aspect of the work that we do, and something that's gotten more and more complex over the years as the markets have expanded and the number of managers and strategies has grown, especially in the private market space and the marketable alternatives space, but also a willingness to use qualitative criteria. Because I think what we tend to see, especially with more junior colleagues, is they do want that checklist, and they can, it feels more comfortable to have something in writing that you can complete and fill out. It gives you maybe a false sense of confidence, but being willing to go out and meet managers in person and try to get a sense of who they are is very important, and mentoring comes into play quite a bit with that.
On the other side too, how can managers best train themselves to articulate their edge? Because sometimes the best salespeople are not necessarily the best investors, and vice versa, the other way around.
We oftentimes have found that the best investors are not the best salespeople, frankly, and it requires a willingness on the part of the manager to be available, frankly, to have sometimes what can be very long diligence meetings with us and walk us through their thinking historically, year over year, decision over decision, why they made that investment, how it panned out, what they learned, whether it worked well or didn't work well. It really allows us to get a sense as to what they were thinking at the time and whether their track record is supported by one or two great decisions that they made, or whether it's something that we find they can repeat over time, historically and on a go-forward basis.
Tom, do you think it gets easier or harder for managers to build their businesses in a world where there's more private capital or more wealth channel capital flowing into private markets?
I think the answer is like a economist, both, yes and no. I think for certain private market managers, it will become easier because they have that kind of built in, the ability to deploy capital. I think for other managers, it would become more difficult of how do we handle that capital, or what are the right strategies. So it really is incumbent upon us on the research side to find those managers that we think are going to succeed in this environment where you have a changing LP base. And that creates new strategies. We talked a little bit about that, where there are going to be additional liquidity solutions. They're just going to need to be provided because you have more investors in terms of magnitude in the private market.
A really interesting point. I want to touch on this before getting to the final question, which is if more wealth investors come into private markets and handling, as you both mentioned, the operational challenges and burdens of working with the wealth channel, does that give the advantage to the larger managers who can handle working with the wealth channel better than maybe a smaller manager can?
In some ways, I think the ability to effectively deploy capital, right? Because I think a lot of individuals in smaller institutions are trying to do is trying to just get exposure into the private markets and build a portfolio that may be at 0 or maybe at 2-3% of a portfolio. So there's a benefit to being able to deploy that effectively, having the operational know-how to handle 100, 200, 300, 400, 1,000 LPs. There's certainly a benefit there. But there's going to be an opportunity for, I think, smaller managers to carve out specific niches. As long as they have the operational and due diligence process built in, I think that's a critical component that's becoming really important to even get into the conversation of, hey, are we going to make that investment? We have to feel comfortable from you from a regulatory standpoint, from an operational standpoint. But I think there is an opportunity for those managers as well.
So, opportunity. I always like to end this podcast by asking everyone what their favorite or most interesting alternative investment or strategy is. I've historically done it looking backwards, but I think the world has changed so much. It's become a much more complex investment landscape. I like to do it now on a forward-looking basis. So going forward, Amita, what is your favorite or most interesting alternative investment or strategy?
I think we're going to see a lot of interesting things coming down the pike as it relates to sustainability and the energy transition. And that's going to take many different shapes and sizes. There's a lot of conversation about whether nuclear is the right option. There's been a lot of historical dollars put into things like wind and solar, and those certainly can be part of the solution. But I think the managers that are going to be able to capture the whole momentum that is the energy transition is going to be very important.
Well, what's fascinating about that is that's such a top-down theme, kind of like AI and digitization or data centers, where you can play that energy transition across infrastructure, across real estate, across equity, venture, et cetera. So you can almost think about it across different asset classes rather than just investing in a single strategy. Tom?
One of our key themes is the expansion of private markets, which I don't think is new to anyone, and really the purpose of this podcast. And so not only do we want to have exposure to private markets, but how do we put ourselves or our clients in the seat of a general partner? And how do we benefit from that expansion that I think we're going to see, the consolidation that maybe you talked about a little bit? And so some of the ways that we like to play that are GP secondaries, GP stakes. We think those would be increasingly important to provide liquidity solutions to underlying GPs as well as LPs. We think there'll be more solutions that come out there. And then finally, this may be a little bit controversial because this has gotten picked up in the media, but we believe direct lending will continue to expand. And so a lot of people have made the comment that there's been such an expansion in private credit, but that really falls the fact that there are more companies staying private, and therefore you need financing for those companies to be able to grow their businesses, to be able to do M&A, to be able to expand into international markets. And that requires private credit to fund that expansion as banks step out of that space.
And on that point too, this goes to what we talked about for much of this discussion is the managers that you pick is what's going to matter. There will be managers who do fine, even though private credit as a space grows. And I know people are worried about private credit because of all the capital flowing in, but there are certain managers who will still underwrite well, who will not be loose on their covenants and will do well. So I think that's a great way to end this conversation, because we talked about so many of those things in the context of this whole discussion. So thanks, Amita. Thanks, Tom. Congrats on the businesses you've both built and now the partnership that you have together. And it's a great conversation.
Thank you.
Thank you for having us. Appreciate it.
Thanks for coming on. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going